Hi everyone, I'm Ricardo Gonsalves with SBS On The Money from the SBS Newsroom for this Wednesday, the 11th of November 2020. It is your daily 10-minute business and finance news wrap. Later, Westpac's Bill Evans on surging consumer confidence. But first, let's go straight to the Australian share market, which made its fifth day of gains in a row. The 200 up 1.7% to 6,449. That's an 8-month high. And that index has risen 8.8% since the beginning of November. We saw broad-based gains today. BHP up 2.3%. Energy stocks doing well. The likes of Woodside up by 6.4%. The banks rising across the board. ANZ the best, rising 3.2%. And some of those stocks that got hit yesterday, the tech sector, they also rose. Afterpay adding 3%. Retailers, though, declined. Some of them anyway. JB Hi-Fi off by 4.4%. Harvey Norman gave up 2.7%, and the Australian dollar also seeing a bit of strength, buying 73.1 US at the close. For more on the day's action, I spoke earlier with Mathan Somasundaram from Deep Data Analytics. Mathan, what's driving the market's continued gains today?
Yeah, I would have thought you'd have seen a bit of steam coming off because I suppose the split in the US market between the Nasdaq and the Dow and S&P not doing much at all. But I think the main player is the currency. We've seen the Aussie dollar now move above 73. That's been the big thematic. So you can see pretty much a one-for-one correlation in the way the market has moved overall. It's just the global guys are just buying our market for the currency move.
Has the market risen too hard in November? We're up almost 9% since the beginning of the month.
Yeah, I think there is a certain level of macro trade, which for an average person doesn't make sense. But when you're sitting in the US dollar, you have, I suppose, a macro risk in the currency and the US market that you have to negate. So for them, even though our markets may look expensive on US dollar terms, it's not as bad because they get the upside in the currency. So if the market falls, sure, you'll get the US market falling and the Aussie market falling, but at least they don't get hit on the currency as well. So they're just diversifying the risk. So the dominant player for the last couple of months have been global guys.
So to what extent are we seeing locally a switch from growth to value stocks right now?
I think that just started in the last week, and that's mainly because of the bond yields. The bond market has realized that inflation is going up. It's a bit like the football teams. Whenever the management comes and says your coach is safe, you're pretty sure he's going to be gone in the next month. And it's a bit like that with inflation. When all the central banks came out and said, don't worry about inflation, guess what? Inflation is going up and the bond markets are moving for it. I mean, the US 30-year bond yield actually moved past inflation, so it's actually in real positive terms. And we've seen today, for example, our 10-year bond yield almost reach 1%. So there is a fair amount of movement in a bond market, and that's telling you need to switch out of growth into value.
I guess over the past few sessions, the market's been alight because of this potential COVID-19 vaccine. So which sectors are likely to benefit from this news? And on the flip side, that stay-at-home trade, has that come off?
I think so. I don't think it has a lot to do with the vaccine per se. You have to remember there's about 140 odd vaccines in play, probably about a dozen that was going to come up with decent updates. And those updates were expected to come in middle of November to middle of December. So the timing is right for things to come through. And I think partly that's why the bond market started to move. It's just that the work from home numbers, the multiples for those stocks gone sky high, like as if you're going to get locked down forever. So those things will unwind. And I don't think some of those things have gone a bit pear-shaped. So I'd expect that to come back. There is obviously the value territory on the other side. So your boring stuff, you got your buy now, pay later going through the sky while the banks are getting slaughtered. So there is a certain amount of rationalization that's got to play out. So I think the banks will have a bit of a bounce. And then the other player where I think the big upside is the resources, because as this plays out, the US dollar continues to go lower. Chinese data continues to be quite strong. Commodities will benefit out of that. So any kind of recovery at this point of the cycle actually favors emerging markets led by China. So the commodities are doing better. So resources is the next place I would be looking at.
Mathan, Somasundaram there from Deep Data Analytics. And as he mentioned, the bank's doing well. We saw a bit of switching of stocks out of pandemic winners to those that were battered over the past 6 months, like the banking sector. And they've done really well since the beginning of November. So ANZ has risen around 11% since the beginning of November. The Commonwealth Bank up 7.7%. NAB surging 18% since the beginning of November, and Westpac up by 5%. And today we saw some numbers from the Commonwealth Bank. It's Australia's biggest lender, and it reported a 16% fall in quarterly profit as higher costs and record low interest rates squeezed margins. Low rates also appear to be encouraging home buyers, though. The CBA adding $5.6 billion worth of home loans during the quarter, and households are saving more with a near $16 billion surge in deposits. And there are also encouraging signs for those who put their home and business loans on hold, because at the end of October, 52,000 loans remain in deferral, but that's down 75% from the June peak. So for more on the sector, I spoke earlier with Elizabeth Tian from Citi. Elizabeth, we're seeing investor support return for the banks over the past few days. Why is that?
A couple of reasons. Like, we're seeing obviously the last 2 days a big rotation back into the banks with the vaccine news, and that's not just locally in Australia, that's worldwide. Money's going back into the banks. What's happened is everything that got sold off in the last 8 months pre the virus, banks, energy stocks, people are switching back into this sector again.
Does today's Commonwealth Bank result give you some optimism about the way the banks are navigating COVID-19?
No, absolutely. We've been actually very positive on the banking sector relative to the market, and the key reason for that is we didn't think that the housing market was going to be as dire as what people were predicting back in March, and that's obviously that's good news for the bank. There's not going to be this mountain of bad debts that, potentially is not going to materialise. So CBA results pretty strong, around consensus. We've seen that in the last few weeks with all the different banks reporting. Definitely the sector is getting more love.
But it will still be tough. Where do you see growth coming from for the banks?
So some of the banks we think are in a much better position than what we thought they were going to be 6 months ago. So growth obviously it's all about demand. Interest rates are at historic lows, but are people really going to borrow more? Surprisingly, and I think it surprised the market the last 2 months, demand for lending, home lending, is much stronger than what people are thinking, first home buyers, and we're seeing really strong numbers on the lending side and even business lending.
What about the challenges for the sector?
Key challenges will be the bad debt provisions. We think that actually they won't, they could be drawn back early next year. Obviously technology, banks will continue to need to invest in technology, and obviously also some of the remediation costs. That's been pretty bad for the banks the last few years, right up to the Royal Commission. We think we might have seen the peak of that.
So given things aren't as bad as first thought, do you think we'll see a return to higher dividends?
Yes, we are pretty confident that dividends will potentially resume first quarter of next year. We have heard APRA say that the restrictions on dividends, that's flexible and that's going to change if conditions get better.
Elizabeth Tian there from Citi. Finally, consumers are more upbeat, which is good news as we head into Christmas. The Westpac Consumer Sentiment Index rose 2.5% to a reading of nearly 108 points. That's a 7-year high, with anything above the index level of 100 suggesting optimists outnumber pessimists. So for more on that, I spoke earlier with the Westpac Chief Economist, Bill Evans. Bill, what's driving consumer sentiment?
I think it's very much the success we're having in dealing with the virus. And of course, the big change this month was the 8% jump in confidence in Victoria. So building on the 32% result that we had over the last 2 months, when the other states were registering their success, now that Victoria is reopening, that provided a further lift and has led us to this 7-year high in consumer sentiment.
Do you expect it to be even higher because of the recent news of a possible COVID-19 vaccine?
I think that'll be a factor, but we have to bear in mind that in the background is that very high unemployment rate. And my expectation is that we're not going to make too much progress next year in bringing that down. So I think at some point that's going to start weighing on confidence.
So just what kind of support is there for jobs growth going forward?
Well, the reopening of the economy, and I think it's likely that the strong balance sheet that consumers and businesses have developed in the last 6 months as a result of the big stimulus that the government has given and their inability to spend much of it. So I think that's a positive, but we do have to get over the deferred loan issue. We have to get over the fact that vacancy rates are rising, population growth is going to be falling. So there's going to be a number of headwinds next year, but it's very good that we're moving into this spending season with such a strong level of confidence.
Can you tell me more about those spending intentions of consumers as we approach Christmas?
I think we're probably there now. We asked this question about, we've been doing it since 2009, about are you going to spend more or less on gifts this Christmas than last Christmas? Unfortunately, Australians are always planning to spend less and more. The average is around 30% less and 10% say more. This time it was about the same. So what I could call that is a normal Christmas. And I guess that we were concerned that given all the uncertainty that we've been through this year, that this year could be quite a damp squid of a Christmas, but certainly the intentions we're seeing from this survey are very much in line with what we've seen over the last 10 years.
And there were some very solid responses about the housing market. What is that showing?
Well, I think the other factor that we saw last week was the Reserve Bank interest rate cut and the commitment not to raise rates for 3 years. That commitment is important for investors as well. And of course,
Bill Evans there from Westpac. And that is On the Money for this Wednesday, the 11th of November 2020. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at Business Ricardo. This On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.